What's up, everyone? It's Caddy with MoneyVest. So Jamie Dimon coming out with some very dire warnings about the US economy and the markets as well. The markets in itself selling off a little bit on the day. We had the S&P 500 dropping about 74 basis points with the Dow Jones down about 1% and the NASDAQ also falling over 0.5% on the day as well. As always, if you enjoyed this video and find it helpful, please make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. And the links to our Discord and Patreon, of course, is going to be down below if you're interested in joining us. And of course, getting access to all the members only private videos, including all the trade alerts and trade ideas, because I do believe there's going to be opportunities coming our way very, very soon, because markets, of course, are pulling back a little bit after being extremely overbought, as we discussed in our previous videos, as well as the MoneyVest index also now rolling over to very attractive levels, not super attractive to a point where the risk reward is finally in our favor again, but definitely coming down to some very, very nice levels as well. And also, we do of course have volatility going higher as well. Now, I also do want to mention and remind everyone that first week of July is the date set in stone that we're doing our internal beta launch for the MoneyVest index. So if you want to take advantage of that, link's going to be down below. So this right here is the update on the platform. This is a video that I posted for our members only, and right now you can lock in a 51% discount of the price itself. So that's going to be for the beta launch, and that will be locked for you forever, because in the future we're going to be adding a lot more data sets, a lot more really interesting analysis, including the MoneyVest index, including the market temperature with the overview of markets technical positioning and valuation positioning, as well as portfolio analysis. So there's going to be a lot of really cool and interesting features that are going to be added over time for you at no cost, of course, if you do join with the current plan. And this again is going to be the website where you can join for patreon.com, and again 51% off the MoneyVest beta launch special price, and that's going to be locked for you forever at a huge discount. Only 17 spots left, so link's going to be down below if you want to join. So first things first, let's take a look at the volatility. So if you come over to the VIX summary, so these are all the spreadsheets, by the way, that are eventually going to be on the platform, and we're just kind of figuring out the data. We're figuring out how we can kind of get the data for volatility, get the data for market breadth, but eventually, I promise you, these are the type of analysis that you can expect for it to be on the platform, for it to be on the website as well. One more thing I want to mention before we get started here is the volatility itself. So up over 14.27, it's up 10% on the day, definitely pushing higher as we discussed in our previous videos. With volatility being really, really low, we were down to the 6th percentile, with the VIX being extremely rare, as we discussed in our previous videos. And that's exactly why I was cautioning for some, for us to be more alert, for us to be more cautious, for us to not go crazy with this run up in the market, considering how low the volatility was and how overbought and overextended the markets were. So 14.28 is where we're at, 27th percentile. Normal right now, and again, in the past, every time we have crossed over 13.95, of course we are above the 25th percentile. That's why we're in 27. But again, the higher we go, the better the opportunities will be for us to buy into the market, for us to dollar cost average into the markets as well. And this right here is going to be the S&P 500. So basically our MoneyVest index that we have created. And right now we're at 3.43. So you can see that it's actually starting to come down. It was much higher. It was closer to 4 back on May 16th. And just to give you a little bit of an idea and how well this index performs, if you come over to May 16th, right? So where was the market back on May 16th? May 16th was literally over here. So this was May 16th. And you can see that May 16th was quite clearly a very, very decent sort of top. It was a level where, we did see the markets pretty much hitting new all-time highs. So it's not like you missed out on a lot of gains. It's not like you missed out on a lot of upside. Let's say, for example, again, this is just hypothetical. Let's say that you looked at the MoneyVest index and you realize that, oh, it's at 4 and it's nearing that 4.1, 4.2 levels. Let me just take some profits off the table here on May 16, May 17. You would have been better off a little bit here, because the markets, of course, are now starting to slightly dip down over 1%, and the MoneyVest index is really coming off. And I do believe there's going to be a better opportunity here for us to buy, because the last buying opportunity, as I pointed out in my previous video, was on April 20th. So this right here was a last very nice serious buying opportunity. So that's the correlation between the money vest index and the markets themselves. And now they're starting to roll over and come down again. The moment it gets down to 3, I will start dollar cost averaging a little bit back into the market, and that could mean the S&P to come down a little bit further. And then of course, if it comes down to as low as 2.4, possibly down to 1.5, those 3 levels, very, very, very important levels on the money vest index, which are going to give us very clear signals to be dollar cost averaging into the markets again, and be very sort of aware of where we are in terms of market positioning. And of course, the risk reward is going to become a lot more favorable for us. So keep that in mind. This is exactly what I'm watching. Nothing else. A very, very good indicator for me to keep in mind. So moving forward with the markets here. So by the way, there's been a lot of power outages here in India. And for that reason, I do apologize. Let me see if the Wi-Fi doesn't go out. I'm just going to quickly go ahead and change my Wi-Fi, because there's been a lot of issues with power outages here in India, and hopefully this works. Anyway, so going back over to, so we covered volatility, we covered the S&P 500 money vest index. So this is Jamie Dimon's extraordinary government spending has him bracing for high inflation and unemployment. So in other words, stagflation. And furthermore, he says that it's a warning Dimon has issued before, previously, saying that he fears that America is headed for a repeat of the 1970s, when everything felt great and then quickly about turned to a period of high unemployment and inflation paired with low demand, also known as stagflation. And appearing at AllianceBernstein's Strategic Decisions Conference on Wednesday, Dimon said that he simply can't see how the past years of massive fiscal and monetary stimulus could result in anything other than this scenario. Asked about the health of the banking sector more widely, Dimon said that he and JP Morgan team are scenario planning for both a hard and a soft landing, and the general consensus from the Federal Reserve is to manage to engineer a soft landing and economic slowdown that won't end in a recession. If you have a soft landing and rates stay where they are, come down a little bit, which is what the world expects, everything is fine. If things get worse, it's going to filter right through all those things, and my view is the world is just not ready for that as well. And he also mentioned that a lot of you in the audience have never seen interest rates at 6% or higher for the 10-year bond. And it is possible. I, for one, think the odds are much higher than other people think. It has indeed been more than 2 decades since the bond yields dipped above 6%. But prior to the late 1990s, this was practically normal. And finally, of course, extraordinary spending. Dimon, who has led JP Morgan since 2006, while economists argue, and Dimon may agree, that spending over the past 5 years has been necessary, the fact remains that America's debt to GDP ratio currently stands around 122%. And it's because of this spending that Dimon is convinced there's going to be a nasty surprise. Stagflation may come to pass. And I'm not saying it's going to happen. I just give the odds much higher than other people. I look at the amount of fiscal and monetary stimulus that has taken place over the last 5 years. It has been so extraordinary. How can you tell me it won't lead to stagflation? So stagflation is really just the idea that unemployment is going to go higher, economic growth is going to slow down, and inflation is also going to be a little bit more elevated, which is going to lead to stagflation. I think it is possible. I think we can expect stagflation as well. I think Ray Dalio and Jamie Dimon are kind of like on the same page, where both of them are expecting some level of stagflation, where inflation doesn't come down fast enough, and it stays a little bit more elevated, higher than what the Federal Reserve's target is. And then, of course, unemployment also starts to kind of creep up a little bit higher moving forward. So that in that scenario, I do strongly believe that interest rates could be higher, or they could go higher and stay elevated from the Federal Reserve standpoint, even from the bond yield standpoint as well. And I think the world really is just not ready for that, because we are constantly expecting interest rates to come down. We're constantly expecting that, rate cuts are going to happen. They're going to take place. And in my opinion, that's the big sort of repricing or disappointment the markets could open itself up to. That's the exposure that we currently have, because if inflation doesn't come down fast enough, interest rates don't come down, and the markets will be left hanging and expecting for rate cuts, which may or may not happen. So those are some things to keep in mind, because As Jamie Dimon also mentions that they are preparing for all scenario planning. And I think that's really smart because I've said this on the channel as well. We're not betting for one scenario versus another. We're just planning for all scenarios, because if there is a recession, if there is a hard landing, if there is a soft landing, if there is economic growth, if there is interest rate cuts, if unemployment goes up, you need to be ready for all scenarios, which is exactly why I think we just kind of cut out all the noise, look at the risk reward, invest smartly, and have some dry powder ready for when the market gives you better and better opportunities. I think that's the best playbook that anyone can have, instead of trying to constantly focus on where interest rates are going or where inflation is going or where unemployment is going to be. I'll give you a simple example, right? ARK Invest has a very macro-driven strategy, right? So if you come over to ARKK, their strategy is completely driven by what the macro is doing, where interest rates are, where economic growth is, where unemployment is, but more specifically where interest rates are. And you'll notice that year to date, the stock, this ARKK, the flagship ETF, is down 16%. Not to mention after hours today, it's down another 1.8%, so almost 2% down on the back of UiPath, because UiPath was one of the holdings in ARK, and it is down almost 30% after hours, a pretty significant drop in UiPath. Not a profitable company. We've talked about this over and over again. And you can't, in a year like this year, in 2024, when the markets are ripping higher than the all-time highs, ARKK continues to struggle right now, unfortunately, down almost 18% this year. Huge underperformance, right? And that's solely because they're very macro-driven. They're betting on this idea that interest rates are eventually going to come down. That's going to help boost their stocks. And as a result, there's lack of sort of quality investing, I would say, lack of profitable investing, because a lot of companies are very dependent on interest rates coming down. So if you find yourself in a situation where your strategy or where your investing style depends very much on where macro is going, where interest rates are going, I would definitely recommend you kind of think twice, because it's really just an idea. It's kind of like a thing that, yes, affects the market, but it shouldn't affect your investing style. I think you should be very focused on investing for the long term in high profitable, high cash flow earning companies that are high quality and at the same time are investable in today's environment, regardless of what could or could not happen in the future. Yes, you need to project for their businesses and how the business growth will be and how the revenue and the cash flows and earnings will grow, but that has nothing to do with whether that's contingent or subject to where interest rates are going, or unemployment is going, or inflation is headed. So their growth should be standalone growth, because they've got a moat, because they've got a good business model, because they're profitable, because they've got good management. Those are the things that we should be analyzing, other than looking at interest rates or inflation. So, and again, keeping that in mind, we'll keep a close eye on, of course, where MoneyVest index is. So the lower it gets down to, the higher the volatility goes, the better the opportunities will be from a risk reward standpoint. So this is the entire market, of course, all sectors selling off. So it was a decently red day. So almost all sectors, pretty much 11 of them were selling off on the day. In the last 1 week, only technology is higher on the back of NVIDIA. So we're starting to see some profit taking, some shifting in tides here. And of course, cocoa prices, volatility was higher. Everything else, feeder cattle, palladium, oranges, sugar, copper, wheat, everything selling off. Bitcoin just over 68,000 and Ether just under 3,800 as well. Now, coming over to S&P 500, as we've already discussed, a lot of consolidation sideways, coming down to its support of 52.65. If it does end up, let's say, breaking down from this level, which again has previously acted as a resistance, you'll notice that this right here is a resistance, and this is going to be a support for S&P 500. And if we do end up, let's say, breaking down, the next support is going to be down at 51.87. So this right here is going to be that next level to watch. And of course, a breakdown below this level is going to be down at 49.55. So sub 5,000 for S&P, which of course would be a very, very nice little correction. And we'd be able to dollar cost average a lot more aggressively into the markets at that level as well. Same thing with the NASDAQ. So starting to roll over a little bit. So down about 58, 59 basis points. So again, very overbought on the RSI and the MACD. So wouldn't be surprised if it does end up, let's say, rolling over a little bit more. And next support really is going to be down inside this green rectangle, sitting roughly between 16,200 and 16,400 inside this green rectangle as well. Coming over to Apple now. So Apple on the day, slightly down, basically flat, so not really doing anything. I did exit out of Apple yesterday, so wanted to take some profits, basically all the profits off the table. Again, coming up to overbought conditions here. It was a very nice trade idea that kind of worked out, and support level is going to stay put inside this green rectangle. That's going to be that first tier support, second tier support over here in the 150s, and the third tier support in the 120s, 130s for Apple as well. Talking about Amazon, and Amazon here also basically flat. It's been rolling over from its highs of 192, so down about 5-6%, and the next support really is going to be down here in the higher lows, along with that 171 support level to watch for Amazon as well. So resistance is going to stay put at 188, support level down at 171, down at 159 for Amazon. Talking about Tesla, and Tesla here struggling a little bit, down about 32 basis points, but really there's been a lack of significant volume. I mean, 54 million shares traded only, compared to over 90 million on a 30-day average basis. So we're now coming down to about half of the average traded volume. So that's really, really low volume. As you can already see, we're starting to see a significant decline in the bar graphs for volume for Tesla. So there's not a lot of interest at the moment for Tesla, and we all know where all of this money is going to. That is going to be NVIDIA. Volume continues to sky high. 55 million shares traded, hitting a new all-time high at over $1,100, and market cap now sitting at just under $2.85 trillion, getting very close to Apple. It's at 2.92, so there's only about, what, 10 billion, or is that 100 billion? I think it might be 100 billion. Yeah, so only about $100 billion difference between the two market caps here for Apple and for NVIDIA. Just crazy how fast NVIDIA's caught up to Apple. So just got to be careful here because it's extremely overbought. And I saw a clip earlier today which suggested that, of course, after the stock split, because there is a lot of positive sentiment on NVIDIA leading up to the stock split, but then after the stock split, it is possible that, of course, we do see earnings multiples again compress a little bit. We do see the price pulling back after the stock split as well. So 10-for-1 stock split coming up for NVIDIA. Advanced Micro Devices also down 3.7%. Again, exited my entire position on AMD as well. Support level is going to stay put at 163, down as low as 151. Inside this green rectangle, down as low as $130 for Advanced Micro Devices, with a huge resistance and target closer to 183 for AMD as well. Talking a little bit about Meta Platforms, and Meta here consolidating sideways. Support level is going to stay up roughly at 453, 457. Resistance all the way up to inside this red rectangle, and that area of supply between 514 and 531 for Meta as well. So a lot of consolidation sideways in that range, and support level is going to stay put roughly at 450s, exactly where it's trading at the moment. Talking about Netflix, and Netflix here continues to hit new 52-week highs. Support level is going to stay put roughly at 637. So this right here, very, very important level of support for Netflix. Resistance all the way up to $699 to as much as $700 for Netflix here. And like I said, support level roughly at 635, 636 for Netflix, all the way down to as low as 594 for Netflix as well. Talking about Google, and Google here consolidating sideways, support level at roughly 173. And again, hitting new all-time highs pretty much at roughly 179, 180. A lot of consolidation sideways, but again, overbought, extended to the upside. Got to be careful with 173 being the support, down as low as 153, aligned with this higher low over here for Google as well. And finally, we come over to Microsoft, and Microsoft here trading pretty much near all-time highs, huge resistance roughly at 430. Support level is going to stay put at 417, down to as low as 398, close to $400 per share for Microsoft. And finally, we come over to Enphase and Costco. And Enphase here, 125 support level is going to stay put here inside this $106, $107 support. Resistance all the way up to 138. That's a triple top, double top resistance for Enphase. We do need to see a breakout above this level in order for Enphase to get up to 150s, but very strong area of support and demand sitting roughly in the low 100s. And Costco is reporting earnings, I believe, tomorrow. So tomorrow they are going to be reporting earnings. Expected EPS at 371, revenue just over 58 billion. I do believe that I think they are going to have very high expectations, which they may or may not deliver. And it's possible that it starts to roll over considering how extremely overbought Costco is, and the valuation, of course, 56 times earnings is no joke, with over 30 times cash flow for this company. PayPal over going to next. So PayPal here continues to slide lower, unfortunately, down about 1.8%. Support level at $57 per share. So this right here, very, very strong area of support and demand for PayPal, with the resistance staying put roughly at around $69, $70 per share for this company as well. And finally, we come over to Visa. So Visa on the day selling off down about 78 basis points. Support level sitting put at 266, down to as low as 249 for Visa as well. So that is going to be that next support and target to keep in mind, with a resistance sitting roughly $282 per share. So hope you all enjoyed this video. And again, keep a close eye on volatility. It's starting to spike a little bit higher. MoneyVest index continues to come down. So we're going to be getting ready for another spree of buying and sending out alerts. So link's going to be down below if you want to join. And don't forget, we do have the 51% discount on the beta launch if you want to join and of course be a part of our MoneyVest internal website launch here. And again, you can access all the platform and eventually that's going to be locked forever as well. So link's going to be down below. There's a 51% discount plus the 16% annual discount available until the end of this month as well. So link's going to be down below. As always, happy investing. I'll see you all in the next video.